Welcome to this explainer. Look, if you've been glancing at the charts recently, you already know things have suddenly come alive again in the crypto markets. But as we're going to see today, we're putting on our financial investigator hats because taking these massive price movements at face value, well, that is a really dangerous game. So let's start with what everyone is talking about. Bitcoin just casually surged back toward the $78,000 mark. That is a massive 20% recovery after a pretty brutal, drawn-out summer. We saw it hit an intraday high of roughly $78,003, bouncing off a low around $76,733, and right now it's hovering near $77,540. Now, to the untrained eye, that just looks like a simple textbook rally. Everything's great, right? But what if I told you these numbers are giving investors only half the story? Instead of just popping the champagne and celebrating a green screen, we need to pause and ask a much harder question. Who is actually doing the buying here? Because right under the surface, there are three completely distinct forces driving Bitcoin simultaneously. You've got institutional money, global macroeconomic liquidity, and of course, pure speculation. And the catch is, if even one of those forces dries up, this entire setup could flip on a dime. We have to figure out which of these is really the one holding the steering wheel. All right, let's dive into Chapter 1, the ETF test. Let's interrogate our most obvious suspect first, spot Bitcoin ETFs. We all know these completely changed the game by letting traditional, everyday investors buy Bitcoin right through their standard brokerage accounts. And honestly, the recent demand is nothing short of staggering. We're talking about $1.6 billion in net inflows over a span of just 4 days. Literally, $606 million of that poured in during a single 24-hour window. You'd naturally assume institutional demand is back and here to stay, right? Well, let's dig a little deeper. Because look at the stark contrast we have going on here. Just a few weeks prior, back in mid-August, the picture looked entirely different. We watched roughly $865 million in inflows suddenly flip to $385 million in weekly outflows. It was a total reversal. And that creates a real sense of suspense for us. Are these big institutions actually accumulating Bitcoin for the long haul, or are they just chasing a quick price pump like retail traders do? Which brings us to Chapter 2. The money behind the move. You see, we cannot analyze Bitcoin in a vacuum. We have to zoom out and look at the global financial plumbing. Now, recently, the market was cheering on the U.S. Treasury's plan to increase buybacks. Everyone basically assumed, great, this means more liquidity for risk-on assets. But there is a glaring, blinking red contradiction here. Long-term yields remain stubbornly high. I mean, the 10-year is sitting near 4.7%, and the 30-year is over 5.2%. Normally, when you have high yields offering safe, guaranteed returns, that acts like a magnet, pulling capital away from risky assets like Bitcoin. So you have to ask yourself, if liquidity is genuinely getting better, why on earth are long-term yields still stuck up there? This contradiction right here is a massive potential trap. It forces us to wonder what exactly happens if those shiny new ETF inflows suddenly reverse again, while macro liquidity is actually much tighter than people realize. We saw exactly what that looks like when Bitcoin violently dropped toward $57,748 back in early July. The floor can fall out incredibly fast if the macroeconomic money isn't there as a safety net. Let's move on to Chapter 3, the supply puzzle. To really make sense of this whole situation, we have to look at how all this volatile demand slams into Bitcoin's entirely unique supply structure. Let's be real, Bitcoin is nothing like a traditional stock. With a regular company, you can open up a spreadsheet and look at revenue, free cash flow, or earnings per share. But Bitcoin? It has absolutely zero corporate earnings and a big fat $0 dividend. You literally cannot value it the way you would a traditional equity. On top of that, there is no CEO sitting in an office who can just authorize new shares when demand spikes. It doesn't work that way. Instead, you're buying exposure to a completely scarce digital asset that's governed by cold, hard mathematical laws. The protocol is hard-coded to a maximum supply of exactly 21 million Bitcoin, full stop. And the rate of new creation is deliberately slashed in half every 4 years through the halving process. Right now, the network is only spitting out a subsidy of 3.125 new Bitcoins per block, and that will drop again until 2028. This means the supply is mathematically constrained. It is completely indifferent to how much Wall Street wants to buy. So because of that absolute unbreakable supply constraint, we have to totally abandon traditional metrics. Things like P/E ratios, toss them out the window. To figure out Bitcoin's true value in this environment, you have to focus purely on tracking liquidity, market leverage, and institutional accumulation. It's a game of flows. You measure the money entering and leaving the plumbing of the system rather than hunting for a dividend yield that simply doesn't exist. All right, up next, Chapter 4, The Psychology of FOMO. Psychology plays an absolutely massive role in a market that's driven purely by supply and demand. Think about the evolution of a typical investor here. The beginner, they just blindly stare at a massive green candle hitting $77,000 and immediately get hit with FOMO, the fear of missing out. Now, the experienced professional, they're a bit colder. They step back and meticulously track those ETF flows and the leverage that's actually driving the price tag. But the true expert, they ask the toughest questions. Is this demand actually sustainable within the current global economy? And what is the real mathematical risk-to-reward ratio for putting capital to work right now? Finally, let's wrap this up with Chapter 5, the scenarios and the verdict. Look, as financial investigators, we don't sit here and make fake, overly precise price predictions. Nobody has a crystal ball. Instead, we map out scenarios. The bull case right now relies heavily on sustained ETF adoption and genuinely improving macro liquidity to keep pushing this momentum higher. But you also have the cautious bear case, a perspective echoed by major analysts like Galaxy Research. They warn that if those ETF outflows return and treasury yields keep rising, all this speculative demand could just vanish into thin air, which would rapidly unwind the whole rally. Now, sitting right between those two extremes is our base case. In this scenario, the market basically hits the pause button after such a rapid, violent move upward. We see it pull back to consolidate at lower historical support levels. Essentially, the market is just taking a breath, waiting to confirm if this multi-billion-dollar ETF demand is a permanent, structural shift or just a temporary flash in the pan. So based on everything we've uncovered today, our final verdict is a speculative watch. Seriously, do not blindly chase this rally unless you actually see confirmation across 5 very specific metrics. We need to see continued spot ETF inflows. We need to see the price successfully hold above those major breakout levels. We need proof of sustained institutional demand, genuinely improving macro liquidity conditions, and absolutely no major deterioration in overall global risk. If those 5 things confirm, the bullish thesis becomes incredibly strong. If they don't, well, you might want to step back and reassess your positioning. As you process all of this and watch the charts play out this week, I want to leave you with the most important investigative question you have to continually ask yourself. When the initial thrill fades and the news cycle moves on to the next shiny thing, is that capital actually here to stay? Always keep your eyes on the flows, not just the price tag. Thanks so much for joining me on this explainer, and I'll catch you next time as we keep breaking down the real data behind the headlines.